Imagine you have $100. You could use it to buy just one company's stock. Or you could instantly become a part owner of 500 of America's biggest companies with that same money. Sounds unbelievable? Well, millions of investors are already doing exactly that. But here's the real question. If ETFs are this powerful, why doesn't everyone become rich? And what is the one mistake that causes many beginners to lose money, even while investing in ETFs? Stay with me, because later in this video, I'll show you exactly how to invest in ETFs the right way, even if you've never bought a stock before. Let's start from the beginning. What exactly is an ETF? Imagine you walk into a supermarket. Instead of buying one apple, one banana, and one orange separately, someone offers you one basket containing all of them. Buying that basket is easier, cheaper, and less risky than relying on just one fruit. An ETF works in almost the same way. Instead of buying only Apple, or only Microsoft, or only Amazon, an ETF lets you own a small piece of all of them with a single investment. That's why ETF stands for Exchange Traded Fund. It's simply a fund that holds many investments together and trades on the stock market like a normal stock. But here's something most beginners never ask. Who actually creates these ETFs, and who decides which companies go inside them? We'll answer that in just a moment. Who creates ETFs? ETFs are created by professional investment companies. These companies collect different stocks, bonds, or other assets into one fund. Then they divide that fund into millions of small shares. Those shares are sold on the stock market. When you buy one ETF share, you don't own the ETF company. Instead, you own a tiny piece of everything inside that ETF. It's one investment, but it gives you exposure to hundreds of companies. Pretty smart. But here's where things get even more interesting. How does an ETF's price change every second if it owns hundreds of different companies? Let's find out. How does an ETF work? Think of an ETF as a giant basket. If Apple goes up, Microsoft goes down, Amazon stays flat, and Nvidia jumps higher. The basket's total value changes. That's why the ETF price moves throughout the day. Unlike mutual funds, ETFs can be bought and sold anytime the market is open. This gives investors flexibility while still enjoying diversification. But don't think ETFs only invest in company stocks. Some ETFs invest in gold. Some follow government bonds. Others focus only on artificial intelligence, healthcare, clean energy, or even specific countries. And this is exactly why choosing the wrong ETF can be a costly mistake. Later in this video, I'll show you how to pick the right ETF instead of choosing blindly. Why do millions of people choose ETFs? So if ETFs simply combine many investments into one fund, why have they become one of the most popular investment products in the world? The first reason is diversification. Imagine you invest all your money in one company. If that company fails, your investment could lose a large portion of its value. But with an ETF, your money is spread across dozens or even hundreds of companies. If one company struggles, the others may help balance the overall performance. That's why experienced investors often say, "Don't put all your eggs in one basket." And that's exactly what ETFs help you avoid. But diversification isn't the biggest advantage. There's another reason that makes ETFs incredibly powerful. The hidden power of ETFs. The real secret is time. Most people think investing is about finding the perfect stock. But history has shown that for many long-term investors, staying invested consistently has often mattered more than trying to pick the next big winner. Instead of constantly buying and selling, many ETF investors simply invest regularly. month after month, year after year. Over time, their investments may grow as businesses grow. It sounds simple, but simple doesn't always mean easy, because there's one mistake that destroys many beginners before they ever see long-term results. The biggest beginner mistake. Imagine you buy an ETF today. A week later, the market drops by 10%. Most beginners panic. They think, "I've made a terrible mistake," so they sell. But experienced investors often understand something different. Short-term market drops are a normal part of investing. Markets have risen and fallen throughout history. Many long-term investors focus on their plan instead of reacting to every price movement. The biggest mistake isn't always buying the wrong ETF. Sometimes, it's giving up too early. Now you're probably wondering, how do I actually buy my first ETF? Let's do it step by step. How to invest in an ETF. Step 1. Choose a trusted brokerage platform available in your country. Step 2. Create and verify your account. Step 3. Deposit the amount you want to invest. Step 4. Search for the ETF using its ticker symbol. Step 5. Read what the ETF actually owns. Never invest without understanding what you're buying. Step 6. Choose how much you want to invest. Many brokers allow you to start with a relatively small amount. Step 7. Buy your ETF. Then stay consistent. Many investors choose to invest regularly instead of trying to predict the perfect time to enter the market. Final thoughts. An ETF won't make you rich overnight, and anyone promising guaranteed profits is being misleading. But ETFs have become one of the most popular tools for long-term investing because they offer simplicity, diversification, and access to many investments through a single purchase. The most important investment you can make is not just your money, it's your knowledge. If you understand how ETFs work, you're already ahead of many beginners. If you enjoyed this video, subscribe for more finance content. And in the next video, we'll explore how to choose the right ETF for your goals and avoid common investing mistakes.